This is a talk on financial planning by the Financial Services Consumer Association. This topic is about buying insurance to manage risk. Advice for consumer is to buy term or accident insurance to cover premature death. Choose a term of 25 years or shorter, and that's because the premium is lower when you have a shorter term, and 25 years is more than adequate for most people who have got the need to provide financial security to their family and children. And now the amount to insure is 5 to 10 years of your earnings. Now the benchmark premium is very important. You can insure $300,000, which is typically the amount needed by most families, and you only need to pay $30 a month. Now this is proportionate, so if you have a higher sum insured, the premium is increased accordingly in the same proportion. Do not pay more than $30 for $300,000 of cover. Now here are some tips about medical expenses. You can buy CPF MediShield to cover catastrophic medical insurances. Catastrophic medical insurance, the coverage provided by this is adequate for most people who wish to be treated, who are willing to be treated in subsidized wards B, 2 and C in public hospitals. Now for young people, the need for medical attention is small, so this is more than adequate. Now if you are working with a company, it is likely that your employer will be providing medical paying for medical bills, so there's really no need for you to have your own medical insurance. So if you have CPF MediShield, which is basic, it is low cost, is more than enough, there's no need to go and buy the more expensive private shield. Now if you do wish to consider the private shield, do look at the lifetime cost, because it may look quite economical at the younger ages, but it can be very expensive when you grow old, so you do not really want to be paying so much for a private shield cover. Now what about critical illness insurance? Now if critical illness usually come at an older age, and the cost of the treatment is already covered by the shield plan. Now if you are critically ill, you might have a loss of income, but if you have savings, that can cover the loss of income. If you put your savings in the critical illness policy, this insurance policy gives you a poor return, so it is not advisable to buy a critical illness policy. And also do not think that the critical illness policy will cover all illnesses. Do be careful what is covered and what is not covered. Read the fine print. But if you are not sure, there's really no need to buy critical illness insurance. Now one of the major risks that you have to cover is the risk of retrenchment, unemployment, loss of job. You can't buy an insurance policy for this, so you do need to have savings that you can draw down upon. So if that happens and you are unemployed, draw down on your savings, and you can avoid paying exorbitant interest on borrowings through credit cards or from a loan shark. And do allow for a period of 3 to 24 months before you can find another job. And also you might find the new job will pay you much less than what you were earning before. So yeah, you do need adequate savings to draw down upon. Now, what about CPF Life? This is compulsory for CPF members, and those who are born after a certain year, you have to buy CPF Life now. The good news is the CPF Life does give a good return on your savings. It is operated on a mutual basis, that is, whatever investment return, whatever is the mortality experience, if CPF Life makes a profit, that profit is shared with all the members. So it is there is no profit made for the shareholders or the government. Any profit is made is shared with the insured members. This is why it's a mutual insurance scheme. Now, if you have a choice, that is, if you are born before 1958, you have the option to keep a minimum sum in the retirement account to be withdrawn over 20 years. Now, the minimum sum, the retirement account, is also a good scheme. So if you wish to keep it in this retirement account and draw it down at a fixed rate over 24 years, it is all right. But if you don't have a choice and you have to buy a CPF Life, that scheme is also quite good for the consumers. Now, you are allowed to choose from two options: the standard plan and the basic option. Both are acceptable, and most people are likely to choose the standard option. So that should be good enough for you. Now, this website allows you to carry out your financial projection based upon your current age, what is the accumulated savings you have in the past, what is your current monthly rate of saving, and then you have got your expected retirement age. Now, based upon this, you will carry out a projection and show you whether your savings is adequate to give you a comfortable retirement, or it is not adequate, which means you still have to work part-time to earn a supplementary income. Now, of course, if it's not adequate, you can increase your monthly savings and then do another projection. Do feel free to carry out several projections. This is the address of the website. This is how the financial plan will look like. The figures are shown here, and there's an explanation on how to interpret these figures, and it does show you your savings accumulated at different gross yields, and you want to invest in the yield that is at least 2% higher than inflation rate. So here is a summary. You should save 15% of your earnings, of what you earn each month. This savings should be in addition to your contribution to the Central Provident Fund. Buy a property within your means, that is not more than 5 years of your earnings. Whatever is your saving, do invest it in an exchange traded fund, the ETF, the Straits Times Index ETF, so that you can get a good return. Have emergency funds so that you do not have to borrow on your credit card or to take other debt and pay high interest rates. So avoid paying interest by building up an emergency fund that you can borrow from, and to provide your insurance protection. Buy term or accident insurance to cover 25 years. The premium you pay is quite affordable.